So here's our next example of our purchase versus lease calculation. In a lease or buy decision, a 4-year lease could be arranged with an annual lease payments of $90,000 payable, but at the beginning of each year, the tax shield from lease payments is available at year end. So the firm's tax rate is 40%. The machinery costs $500,000 and has a 4-year expected life and no residual value is expected. So if you purchase this, the asset will be financed through a term loan at 12%. The loan calls for equal payments to be made at the end of each year for 4 years. The machine would qualify for accelerated capital cost allowances written off on a straight line basis over 2 years. So calculate the cash flows for each financing alternative. Which alternative is the most economical? So our lease payments, what did they tell us? $90,000. So our lease calculation here, we have our lease payment over 4 years, $90,000 a year. Our tax savings is 40%. So we're going to multiply that amount by 40. So deduct it, the tax savings from the lease payment, and we're going to get $54,000 a year. So the after-tax cost of leasing is $216,000. So the purchase decision. So we have a loan, we can figure out the payment. So the beginning loan balance is the price of the equipment. The equipment is $500,000. So we're getting a loan for 12% over, oh, it doesn't say years. We'll say, I'll type that in. 4 years. So we end up with a present value annuity factor of 3.0373. So we take see the formula there, we take our balance, divide it by our present value annuity, and we get a payment of $164,620. So our payments are going to be the same every year, so we can just copy that right down. Our interest of 12% is going to be on the balance at the beginning of the year, right? So we're going to multiply the $500,000 by 12%, so we're going to pay $60,000 in interest. So if we deduct the $60,000 from our payment, we get our principal payment, the principal amount we paid on the loan. So do we have maintenance on this? No. Our CCA for our item, they told us that we are going to do accelerated depreciation written off on a straight line basis over 2 years. So we're just going to take, to get the CCA, we're going to take the $500,000, divide it by 2. So we're actually going to depreciate $250,000 in year 1, $250,000 in year 2, and then it's depreciated in 2 years. So our tax deductible expenses is our interest, our maintenance, and our CCA. So we're going to add those 3 together and get $310,000. Our tax savings, 40%. So our after-tax cost of owing is we take the payment and we deduct the tax savings. So we're taking the payment of $164,620, deducting our tax savings of $124, and we get our after-tax cost of owning. So we keep going through this process. So our beginning loan balance is the $500 minus the principal paid that year. Our interest is 12% on that amount, that balance. Then we deduct that from our payment to get our principal. And we add together our interest, maintenance, and CCA. We have tax savings of this much multiplied by we multiply 40% by our tax deductible expenses. We deduct our tax savings from our payments for the year, and we get $45,642. So we keep going with our loan balance is $395 minus our principal of $117, and we multiply that number by our interest. We have our interest amount here. We deduct our interest amount from our payment to get our principal payment. So our interest and our maintenance of CCA is nothing. So our only thing we have is interest. Our tax savings is 40% of that. And our after-tax cost is $151. So the last year here, we had our balance of the loan was $278. We paid $131. We multiply the $146 by 12% interest. We deduct that interest from the payment, and we paid $146,983. So pretty close with some rounding errors. So we paid $13 extra in the rounding errors. Our interest we paid. So our interest is all we have to deduct, right? Multiply that by 40. Deduct from our payment the $7,000. Our after-tax cost of owning is $395,093. So that's quite a bit more than the $216 of leasing, right? We don't have any residual value in this case. If we had a residual value, we would deduct that from our after-tax cost of owning, and it would be if this item was worth $100,000 after 4 years, we would deduct that. So in this case, our lease here is the better deal. It's more economical for our company. So I hope that helped you with how we would figure out the economics of the lease versus buy when we consider all the after-tax expenses.